Welcome to Herb W. Morgan's weekly economic and market commentary, a podcast about markets, investing, politics, and profit. Each Monday, in less than 20 minutes, Wall Street portfolio manager Herb W. Morgan distills all the complex and complicated into the simple and sensical. Here's Herb.
Cantor Fitzgerald managed ETF portfolios. I'm trying something a little new today on the YouTube channel. We're doing a live live webinar where we're going to give you the economic and market commentary. Hopefully, we'll try to do this once a quarter, in addition to the regular weekly content that we put up, or that I put up on the YouTube channel. This presentation that you are hearing has been prepared by us, Cantor Fitzgerald Investment Advisors, for use with investors and financial advisors, but each are expected to make their own investment decisions. Nothing contained in the presentation should be treated as investment advice. There are no recommendations for the purchase or sale of any securities. The information contained herein is purely informational, and its accuracy, adequacy, or completeness cannot be guaranteed. Let's get into it. Okay, we all know how great it's been for investors the last, let's call it 16 months or so. It's been fantastic. Last year, 2023, you can see here the S&P 500 returned 27%, 26.6 to be exact. Significant outperformance of large cap, that's the S&P 500, over mid and small cap, that's the 4 and the 600. Why? That's where the big cap technology names are, and big cap technology has been the driver for these returns. Emerging markets did well, also 10%, but that's just a fraction of what we got out of large cap tech. The story, the theme in the marketplace today has been, and it has been for some time, all about large cap tech, which is dominated by the United States. In fixed income, interest rate hikes all year last year. Normally, interest rates going up means bonds do what? Go down. But those hikes were only at the very short end of the curve, and the longer end of the curve began to anticipate not only an end to those hikes, but began to anticipate rate cuts. So even bonds had a positive return last year. Look at high yield, double digits, almost 13% return out of high yield paper. As we got into 2024 on April 2nd, I grabbed the data for you all. We're almost to double digits on the S&P again. Again, S&P is leading. Pretty good participation from mid-cap. Small cap lagging considerably. International lagging, but doing well. And then mixed results out of fixed income. My agenda today is really pretty simple. And I can't get the slide to move again. There we go. We're going to cover how we got here. Where are we exactly sort of within the economic cycle? What is the likely direction of the economy and consequently the markets and therefore our portfolios? The likely direction we see from here. We're going to look at things that could go wrong. There's always things that can go wrong. We can have external shocks like we did back in 2020. Things were booming and all of a sudden COVID appeared on the investment landscape. And then we're going to wrap it up with talking a little bit about how our portfolios are currently positioned for our investors. Let's start with how we got here. I think the best place to go back to was very significant economic legislation that came out of the Congress in 2017. The Speaker of the House back then was Paul Ryan. It was called the Tax Cut and Jobs Act of 2017. It was the first major set of changes to the tax code since 1986. So it was very substantial. And the Tax Reform Act of 1986 had a substantial impact on the economy and the markets and investing. And there has been legislation, yes, but not anything this significant or this really stimulative. It was a major reduction in the corporate tax rate from 35% to 21%. Pass-through entities, that's your LPs and your LLCs, received a deduction of 20% from their pass-through income. Just take 20% off the top. You had 200,000, take off 40,000. Reduction to individual tax rates. We also increased standard deductions from 6,500 to 12,000 And for married couples, 13,000 to 24,000. That was significant. That put more money in taxpayers' pockets, corporations' pockets, etc. More money in taxpayers' pockets led to more consumption. More money in corporations' pockets led to stock buybacks, dividend increases, capital expenditures, wage increases, bonuses, other things. We increased the exclusion for estate taxes. Deduction for mortgage interest, though, you could no longer deduct mortgage interest on the amount over $750,000 of a mortgage. Before that, it was unlimited. Deductions for state and local taxes were capped at $10,000, and many tax deductions for self-employment or unreimbursed business expenses ended up being eliminated. There became 100% bonus deduction for business assets purchased all the way up through 2022. So this was passed in 2017, but you could fully expense in year one many business assets through 2022. And U.S. corporations or individuals, I guess, that own more than 10% of a foreign corporation and receive dividends from that ownership, those dividends became tax-free. This was a major growth, pro-growth, pro-employment piece of legislation. Then we got hit with that external shock, and we got a bear market in 2020. Okay, I'm learning how to advance these slides. Well, I have my laser pointer on. You can't do it. Okay, on March 15th of 2020, we began to restrict supply in the economy. State and local governments began to implement shutdowns in order to prevent the spread of COVID-19. There were severe worldwide economic restrictions on normal economic activity at a scale never before seen. Forced stay-at-home orders, even of questionable legality at the time. Can you really tell people they have to stay in their house, that they can't go to a park, to a ball game, to a concert, can't get on an airplane? Speaking of airplanes, we went from about 2.3 million passengers a day to 146,000 passengers a day. We closed down schools. We closed down restaurants, sporting events, offices, factories. Everything was closed. And so for the first time in our nation's history, we had a supply side recession. All prior recessions had to do with demand. There was demand destruction or demand reduction. And so there was a response, which throughout our history has evolved to be the Keynesian response, coupled with a monetary response, that was always used to address these demand side recessions. This was a supply side recession, and it was unique, and it's never been seen before. So we went and we attacked it with both monetary stimulus from our Federal Reserve, our central bank, and fiscal stimulus from our United States Treasury, or our Congress, that approves spending. And it was pretty massive. And it wasn't just the US, it was literally every country in the world enacted monetary and fiscal stimulus. Even non-countries, places like the IMF and the World Bank, all enacted stimulus measures at a time that the economy was suddenly and sharply put into a recession. But it wasn't during a period of no demand. Demand was strong. The economy was booming. What we did is we shut down the supply of the economy and then stimulated it. It didn't make any sense. And we put the stimulus out and saying, but don't go to work. Don't open your factory. Don't go to school. Don't do these things. Yet we still flooded the system with money and with fiscal stimulus in the form of government spending. The federal funds rate was cut from 2.25%, which is pretty low to begin with, which was positive and stimulative, to 0.25%. The Fed printed over $5 trillion. They do that by buying up U.S. Treasury securities and mortgage-backed securities to drive interest rates as low as possible. They created multiple lending programs, such as the primary market corporate credit facility. We lent money to companies through special purpose vehicles. Usually those vehicles had Treasury funds of, say, 10 or 20 billion, and then the Fed provided leverage by lending billions and billions and billions of dollars to those. The primary market corporate facility and the secondary market corporate facility, which bought corporate bonds. That's in addition to what we think of as normal monetary policy. They even bought bond ETFs, all of this to the tune of $750 billion. There was the TALF, Main Street Lending, municipal liquidity facility. There was a primary dealer credit facility at money market to support money markets to prevent the breaking of the buck. There was a commercial paper credit facility. All in, depending on how you measure it, and there's debate here, monetary stimulus was, in my mind, $6 trillion. But I want to be conservative in this and say that some people estimate it between about 3 and 6 trillion. It was really about 6. You can say 5 if you want, if that helps, make you feel better. But that's just monetary. Then we had fiscal stimulus. Fiscal stimulus schemes were also implemented around the world, but at a size and a scope never before imagined. This was showing up to a knife fight with a nuclear arsenal, not a nuclear weapon. I mean a nuclear arsenal. Coronavirus Preparedness and Response Supplemental Appropriations Act of 2020. That was just a quick, hey, the Congress had already approved a budget. Let's approve a supplemental $8 billion and stimulate the economy. Big deal. Families First Coronavirus Response Act, another $3.5 billion. Coronavirus Aid, Relief, and Economic Security Act, $2.2 trillion. Now we're talking nuclear arsenal. Paycheck Protection, Healthcare Enhancement, $500 billion. Response and Relief, $14 billion. And then the American Rescue Plan, $350 billion. So fiscal stimulus was $3.2 trillion. I just showed you the monetary, and I really think it was closer to 6, but let's call it a grand total between the fiscal and the monetary of, let's call it $8 trillion. You realize that was double the stimulus for the global financial crisis of 2008, which came in at around $4 trillion. The stimulus for the global financial crisis of 2008 was by far, in a way, the biggest ever seen, even adjusted for inflation. Nothing ever came close. So this new economic thinking is, let's not fine tune or tweak our economy with monetary and fiscal stimulus to help us out in different places or adjust things or get it on the right path. We're just going to say what we want, and we're going to go out guns blazing every single time. That is the new economic order. That is what is happening. I don't think there's enough data to determine whether or not it's right, but we stimulated an economy that was robust, dare I say, almost ebullient. We stimulated it with $8 trillion. That is an amazing amount. I want to share with you now a quick video. This is me on CNBC on March 19th, 2020. At the time, the market was down from its high. Well, you can see it right there, 32% from its high. The markets were panicked, the governments were panicked, the central banks were panicked, and they were now throwing out all the stimulus I just told you about. Nominal GDP growth was down 7% for the quarter. Now, the quarter hadn't ended yet, but it turned out to be down 6.9%. Take a quick listen.
Rick, I'm going to pick it up actually, but thank you very much for that. Morgan, coming back to you, you mentioned the letter V, which is important at this time, and it's encouraging to hear it. Do you feel like markets will be able to bounce meaningfully just because of things like central bank and fiscal stimulus, or do we still need to wait until the fundamental numbers relating to the virus are blocked?
Well, I think both, and I think they may happen right along the same timeline. I mean, think about what the Fed has already done: 150 basis point cut, 1.5 trillion in reverse repo, 700 billion in announced QE, restarted the commercial paper facility, restarted the primary dealer credit facility. We've announced an 8.3 billion fiscal package, a 1.3 trillion fiscal package, and then right before I went on, I heard we're talking about a phase 3 for another trillion. 50 billion in state of emergency funds, 300 billion in liquidity from extending the deadline to pay taxes. Australia, Hong Kong, China, South Korea, the UK, Germany, France, Italy, Japan, and Canada all announced stimulus. IMF 50 billion, World Bank 12 billion, IMF's got another trillion in lending. How can it not be?
When you put it that way, Herm, that's a lot of stimulus. We will leave the conversation there. Thank you.
And so here we are. And of course, that was very close to the bottom of the market. And by June, a year later, the year-over-year growth in nominal GDP had gone from a minus 7% to a positive 17% as a result of the stimulus. The minus 7% wasn't a lack of demand. This is so key to understanding what's going on here. It was a shutdown of supply, and then we stimulated by creating more demand for a period of no supply. And that brings me to my favorite economist, who's most famous, many famous quotes. This is Milton Friedman. Milton Friedman said, and is most well known for saying, that inflation is always and everywhere a monetary phenomenon. But most of the people that quote him don't go on and add the full sentence. Full sentence says, in the sense that it is and can be produced only. In other words, inflation can only be produced if you print more money than your output grows. If your economy grows 5% and you add 5% to your money supply, that's not inflationary, is what he's saying. So what did we do? Did we print more money, or did we overstimulate? That's my point. That is what happened here. Let's move on. And so inflation surged from sub 2%, where it had been really since 2018 by a good 3 or 4 years, to almost 6% in a very short 2-year period as a result of what we now know was excessive fiscal stimulus and excessive monetary stimulus, coupled with the first ever set of supply restrictions. All of these things serve to drive inflation higher. The other thing that drives inflation higher is fiscal deficits. Why is that? Well, if your economy naturally is of a certain size and the government takes part of the economic output in the form of taxes and spends it in the form of essential services like education and airports and roads and military services and trade negotiators and all the different important things the government needs to do, well, that's kind of a neutral. Maybe it's a little negative. But when you deficit spend, that is demand. The formula for GDP, by definition, consumption, what you and I do, investment, what businesses do, plus government spending. So government spending is a positive contributor to GDP. And when government spends more than it takes in, it contributes even more to GDP. That could potentially be a positive, right? It's stimulative. It could even be inflationary, right? The famous economist John Maynard Keynes always said, look, when an economy lacks demand, we're going to have fiscal stimulus. Oh, the over-exaggeration of that, this little cartoon here, in case of unemployment, break the glass and then sweep up the broken glass. John Maynard Keynes was famous for saying, just pay people to dig a hole and then pay them to fill it back up again. Now they have money that circulates through the economy. You stimulate aggregate demand. But again, I'm saying this so many times, there was nothing wrong with demand. So we were applying stimulative theory without a lack of demand. At the same time, we couldn't meet that new demand because we shut down the means of production. This was happening not just in the US, but worldwide. Since then, inflation has come down significantly, but it does remain well above the Fed's target of price stability. The fiscal deficit as a percentage of GDP remains, in my opinion, in inflation-inducing territory. Going back one slide again. You can see here from 2015, the deficits as percentage of GDP started getting progressively larger. 2%, or let's call it 2.25%, 2.3%, as it moves down. I get my little laser here. We're going to move down here. Bigger, bigger deficits. Massive deficit, which is traditionally what you do at a time of war or recession, but we've never done it at this size before. And now that we're in boom time, you would think we would be back to zero or a surplus or even a small deficit of 2% of GDP. But no, the new norm for our Congress is massive deficits, which are stimulative, yes, but also contributing very significantly to the inflation, which we don't want. Fed funds rates are not having the impact they normally have. So we've been raising and raising and raising the Fed funds rate. It says cuts here. We're going to change that to hikes. Are not having the impact of slowing the economy down. I'm going to show you why in the next 2 slides. Money is still oversupplied to the U.S. economy because of that $5 trillion the Fed printed. They've now deprinted $1.5 trillion of that, but we still have excess liquidity, more liquidity than we need in the economy. And let's not forget, the Tax Cut and Jobs Act of 2017 is still the law of the land. It hasn't been repealed. There was no major substantive tax code changes. There has not been any since 2017. So let's take a look at this real quick to see what I mean about this. So household debt, that's your debt and my debt. That's our mortgage. That's our credit cards. That's our cars, etc. As a percentage of our disposable income. Well, up all through the 90s, really peaked the global financial crisis. It was too high. U.S. consumers, us, you and I, were over-levered. We had too much debt. But since then, we've gone to about 135% of disposable income, all the way down here to just under 100% of disposable income. In other words, you and I are stronger, more capable in the aggregate than we were back in 2008. Household debt service and principal payments. In other words, how much of your income has to go to pay your mortgage and your mortgage interest, your credit card interest, your car payment, both principal and interest. You can see, let's go back, 2008. It was over 13% of income. Today, it's below 10. So that shows you that the consumer is strong. Once again, I can go back to this theme. There's not a demand issue in the economy, right? Just go out to a restaurant, or try to get a hotel room or an airplane ticket, right? You can see how much demand there is in the economy. But that's households. What about corporations? How are corporations doing? Well, let's take a look. U.S. non-financial net interest expense, corporate interest expense as a percentage of gross domestic income. Going back to the 80s, right? Look at this. Interest expense, 3.5%. Now down getting close to 1%. But wait a second. The Federal Reserve's been raising interest rates. That's supposed to cause us to have more interest expense, humans, consumers, and corporations. And if we have more interest expense, that slows down the economy. But instead, we were smart. All of us were smart. If we had mortgages, we refinanced them to 30 years at incredibly low rates of 2%, 2.25%, 2.5%. We locked in low interest expense for the next 30 years. Corporations did the same thing. Big companies like Google, Apple Computer issued bonds in the low single digits. And so the net effect was that non-financial, meaning non-banks, net corporate interest expense is actually a declining part of gross domestic income. So now that interest rates are going up, we're not paying more in interest at the household level. Maybe new borrowers are on the margin, right? But so we're not getting the impact that they want from raising the interest rates. So where are we? What's going on? What's next? Let's get this over and laser and move on. Okay. The money supply, remember Milton Friedman's famous quote about the money supply and the growth of the economy. So back here to the recession, get my laser, a little laser. Okay, right? We had money supply growth of 25% with GDP growth of minus 7%. Money supply growth of 25, GDP growth of minus 7. Okay, well, I get it. You wanted to flood that to reverse the 7%. But that amount of money supply growth, of money printing on a year-over-year basis, this is my comment about bringing a nuclear arsenal to a knife fight, right? We did that. Since then, good news is we saw the inflation. The Fed is mandated by law to attack the inflation, to try to deliver price stability. So the Fed says, well, we're going to raise interest rates. Done that a lot. We're going to deprint the money that we printed. And so they've been doing that since 2022, late 2022. So about a year and a half. Year over year, money supply growth has actually been negative. There's never been a period in U.S. economic history where we had a negative growth rate to the money supply. Again, normally you would think that would cause a recession, just like raising the rates. But because we still haven't reversed nearly, only a small amount. We printed 5 trillion, we've reversed out 1.5 trillion, right? There's still 3.5 trillion out there. So money is still oversupplied. So why hasn't the market corrected? Why haven't we gone into a recession? Well, as I said, We don't have a demand problem. We never had a demand problem. And we treated a supply shock, an external shock bear market, we treated it with massive demand side stimulus on top of demand stimulus we already had as a result of the Tax Cut and Jobs Act of 2017. This is the Bloomberg estimated earnings per share graph. It's a forward 12-month estimate that how much will the S&P 500 earn in profit. Well, if you go back here, right, circle this right here to the, the bad days, right? When I was on the little CNBC interview, the estimate for earnings for the S&P 500 had gotten down to about $140 a share. Today, not quite a double, but we're at $250 a share. Why? Well, the Tax Cut and Jobs Act of 2017 incentivized corporate investment in a way never seen before in the U.S. tax code. It reduced the cost of success. So it's a different calculus when you're thinking like, well, if I invest this money, I risk losing it. But if I do make a profit, it's 35%. But now if I do make a profit, it's only 21%. That's more incentive for you to invest. Corporate balance sheets are amazingly strong. I talked about issuing debt at 2%. Now they're sitting on that debt, investing it in cash instruments, earning 4.5% and 5%. This is causing earnings to go up literally by the interest they're earning for some of these companies on their balance sheets. On top of all of that, you can never count out innovation to deliver productivity, i.e. earnings. And the next earnings per share driver is probably artificial intelligence. Artificial intelligence has been driving big cap tech earnings, right? As companies adopt and spend. And we talked about that in the beginning. And we'll talk about where we're overweighted as we progress. But now it's time for artificial intelligence to percolate through the rest of the economy and to begin to deliver productivity and earnings growth there. So the earnings are doing great. GDP, which is another reflection really of earnings, is also doing great. You can see here that fourth quarter GDP was revised a little higher last week from 3.2% to 3.4%. Personal consumption, which is just a major important component, also revised up from 3 to 3.3. Normally, if you deep print $1.5 trillion and you raise interest rates and you raise interest rates and you raise interest rates, you get into recession, or at least a slowdown, or you remove the inflation from your economy. But at a 6.5% deficit to GDP, you still have a major inflationary force. And the Tax Cut and Jobs Act of 2017 is a major growth force in the economy. We know the economy is not slowing down because weekly claims for unemployment are incredibly low. They're as low as they were in the late 1960s when the labor force was less than half as large as it is today. Weekly initial claims for unemployment are running around 210,000 per week. And in a country with 350 million people, that's a really, really low number. We're also seeing sentiment start to pick up among consumers. You can see here on the right-hand side, my little laser printer here, since July of 22. So we're now coming up on 2 years of slowly increasing consumer sentiment. Again, not back to where we were pre-COVID. Tax Cut and Jobs Act of 2017 ebullience. But we're seeing, people are seeing their home values go up. 401k values have gone up. They're able to travel again. They're able to have fun again. All of those things are contributing to more sentiment. Recently, sentiment went up on a pullback in gasoline prices. That seems to have been now rather short-lived. Now, this chart is hard to understand. So let me make it real super easy and clear. These lines all represent economic surprises. When the lines are going up, it means the economic reports are coming in better than expected. They are a positive surprise. And you can see here, the white line is the United States. You can see it going up and to the right at 41. The Eurozone is the orange line. That one's a little weaker, but still positive. And it was much positive. They'll probably cut interest rates before we do, is bottom line there. China, yellow, positive, coming up. And Japan, green, also positive going up. So all the major economies are seeing economic surprises to the upside, even while we are raising interest rates. Well, why? Tax Cut and Jobs Act 2017, major stimulative, massive deficit spending by the United States of America. So, what could go wrong? I don't know. Let's ask the Secretary of the Treasury. Secretary of Treasury has to put out a report every year. It's a simple financial report of the United States government. It must be put out in the United States Department of the Treasury's financial report, the United States of America for the fiscal year 2023, which ended at the end of, I think, September or October. Starts out with this headline. A sustainable fiscal policy is defined as one where the debt to GDP ratio is either stable or declining over the long term. The projections based on the assumptions in this financial report indicate that current policy is not sustainable. So the Secretary of the Treasury is telling the Congress is who approves the spending, the president then signs, that what you're doing is not sustainable. It cannot be done for a long period of time. In fact, economic theory has always said that. You do it in time of recession or you do it in time of war. But we're in neither right now. And that is something that could go wrong. All right, here we go. All right. So where are we? Debt levels in the U.S., the orange line represents the debt level of federal debt. That's the debt of the United States Treasury as a percentage of our gross domestic product. We are at 121%. Historically, anything over 100%, you're in the danger zone. And you can see we were in that 100% level for a very long time, shot way up with COVID. Now that GDP has come up, the debt level as a percentage has gone down. That's the bad news. The good news is that household debt levels, which were at 100% back during the global financial crisis and helped lead to the global financial crisis, are now down to 71%. So the consumer rate remains strong. That's why, despite the danger, we're not in this recession yet. We haven't collapsed yet. But what if we pulled the Tax Cut and Jobs Act of 2017, which has been a major driving stimulative force? Well, by design, the Tax Cut and Jobs Act of 2017 is scheduled to go away. The marginal income tax cuts expire at the end of next year. The standard deduction amounts revert and then index for inflation, so they expire at the end of next year. The phase out of the state and local tax deduction expires. I'm happy about that one. I live in California. Mortgage interest deduction will now go from a $750,000 mortgage cap to $1 million mortgage cap. The 199A deduction for pass-through business income, the exclusion of 20%, that goes away. Fully expensing a property used in trade or business really kind of went away mostly now and is continuing to go away and phase out completely by the end of 26. Estate and gift tax exclusions, where we raised the estate tax limit, went up, will go away, will revert back. And the opportunity zone investments, which allowed for capital gain tax deferral, that also goes away at the end of next year, unless the Congress at the time or sooner, could do it now if they wanted, could extend any or all or part of this. And then the other thing we've got going, of course, that a lot of people are worried about is it's an election year. We've got two very colorful and interesting candidates. There's a third party candidate now. And I don't like to get into politics by any stretch of the imagination, but there are significant implications that could come from the election. What if one party gets total control? House, Senate, presidency. What if it's a mixed result? What if one party has the House, the other party has the Senate, and one of them has the presidency, etc.? What is likely to happen to the Tax Cut and Jobs Act of 2017? Right? What is likely to happen to the corporate tax rate? What is likely to happen to the incentives that were put into the system to grow the economy, to invest, and so forth? All of those implications, I don't think we know right now. I just don't have a feel for how this election is going to go. So how are we positioned? Well, our current equity positioning is neutral. I'm real positive on the consumer. I'm real positive on artificial intelligence. I'm positive on corporate balance sheets. All of these things at the same time I'm very concerned about debt levels at the federal, state, and local level, particularly federal level, And so, and also valuations are not low. I like to be a value investor. So I'm neutral. I'm neutral on equity. And so each of our portfolios, as you may know, we have an asset allocation guideline. We have why am I having trouble saying this? Benchmark. Our benchmark weightings for equity. The benchmark weighting for equity is neutral. But within equity, we are still overweight U.S. versus international because that's where the growth is. We have a 73% U.S. target, but U.S. is only 60% of world market capitalization. Part of that is a permanent bias, quite frankly, because our investors are in the United States. Almost all of you are in the United States. We believe that the growth is coming not just in the U.S., but large cap U.S. So we're at 62.5 versus 51.5 in the benchmark. And then within that large cap, it's an overemphasis on large cap technology. We do that through inclusion of the QQQ ETF. With U.S. mid and small cap, we are at 10.5 versus 2.5. International 27 versus 42. So we're underweight significantly international, but that all comes from large cap international. We still like the growth prospects of emerging markets. So we're equal at 12%. And within emerging markets, we have a very specific tilt towards China. We believe that all the fundamental reasons not to invest in China are known. They are priced in, and the markets have become incredibly cheap. And in fact, let's go to the next slide. And that's not the slide we were looking at. We're going to get to it in the next one. The reason we're only neutral equities is this. The Fed model of stock market valuation. It compares the earnings yield of the S&P 500, which is 4%, to the risk-free yield of the U.S. 10-year Treasury, which is 4.38%. And when you have a gap like this, stocks are said to be fully, if not even somewhat, overvalued. Normally, it's the reverse the other way. The purple line is above, right? Back here in April of 2023, you had the earnings yield at 5, okay? And the U.S. Treasury yield was all the way down at 3.5. You got to pay the premium to own stocks because stocks are riskier. Right now, you get a premium to own bonds. So let's have plenty of bonds in the portfolio. Let's collect that. Now on to that tactical play on China. This is a busy line here, but this is the Shenzhen 300 index. You can see over the years, big moves up, big moves down. This is where we are today. And we also, on this lower graph, we put in the price earnings multiple, where the S&P 500 is in the low 20s price to earnings. The Shenzhen 300 is down. It got as low as 9 recently, but it's roughly around 12 now. And what happens when it gets down to this level of about 10? Well, in most cases, on average, over the last few occurrences, average return is about 44% in 10 months. So we like China for a tactical play within the portfolios. Moving on to fixed income. Fixed income positioning, a little bit overweight. Why? That valuation chart I just showed you. Real returns possible for the first time since the global financial crisis of 2008. As inflation comes down, if it continues to come down, I'm worried the next move down to 2% is going to be very challenging. But if it does, until then, we're getting paid a little more than inflation to own bonds. That's what we call the real return. Within fixed income, we've got about 70% in U.S. Treasuries and mortgage-backed securities. That's in line with the benchmark, provide high liquidity, don't have a lot of credit risk. Obviously, the Treasuries have no credit risk. It's the easiest way for us to control duration and move large amounts around very efficiently. But we're also about 30% corporate versus the benchmark, which is also 27. But we're different in that we have 10% of that in short-term high-yield bonds, which are lower credit quality. The aggregate bond benchmark does not have any high yield in it. We're also just a little short in duration. That's interest rate sensitivity. In case interest rates do shoot up because of this inflation problem, we're a little short here at 5.4 years versus the benchmark at about 6.3 years. Hey, thanks everybody for tuning in. I really appreciate you doing it. This is available on a weekly basis on audio and all little podcast formats. But down here in the lower right, you see YouTube. We do this with a video. You get to see me and see the slides. And that usually comes out Monday morning. Thanks again for tuning in. We'll be back to you again later.
Thanks for listening. If you'd like to download the slides for this week's podcast, please visit www.efficient-portfolios.com, where you can subscribe to the weekly commentary podcast in all the usual ways. And if you wouldn't mind, please rate us on iTunes and tell a friend.